So I think the real added benefit of country experience is that you get extremely different pictures. And I think, Benjamin, you said at least it's the last bastion we have at the national level. I don't want to discuss now whether it will be useful, whether the ECB, at least the framework, would give some kind of harmonization. But let's discuss something else. We heard a lot of instruments, so I think we are now finishing almost the 2 days. So we are moving from the financial sector that is really borrower constraints. I think that's more or less what. But then the choice of instruments, and I would like to ask all three. So you have LTV, you have LTI or DTI, and you have debt service to income. You have these three, and then amortization. But among these three main instruments, which one is your favorite, or do you want to make a combination, and also on effectiveness? Can I start with you, Benjamin?
Maybe let me start what we thought when we recommended it. The idea was to have many instruments so that we can have a convex mixture of instruments to address the systemic risk that we want to limit. So I wouldn't prefer one over the other, but would think that the analysis just guides us in how much weight we put on the various instruments. So it's there. I don't have a preference, but unfortunately, the convex mixture is not possible, at least from based on the bill we have now. So we only have the LTV and amortization requirement, and we have to see how we can operationalize that.
Karsten,
what
is your experience?
So no problem. No, I think I agree with Benjamin. I don't think I have a preference for either one either. It must depend on the situation. I think, obviously, the situation we're in, I think we've chosen the appropriate measure. One concern would, of course, be like if you take medicine, and you take your medicine for one thing, and then you get a side effect, and then you take medicine for another thing, and for you know it, you are on all sorts of pills. There's a complicated interrelationship between these measures, so I don't think we should be too optimistic on how much we can fine-tune the use of them. But
yeah, but still, I want to go one step further, because you have experience. Germany has less house pricing, so you have experience in Denmark. I would put a knife on your, and if you have to make a choice, so is one working better than the other? Because of course it's always dependent on the situation, but are there issues, are there pros and cons on each of the two instruments, so LTI and LTV?
No, I think, as I said, to tell you the truth, I wouldn't know whether one is working better than the other, because this has not been implemented yet. Yeah. So it's really difficult to. So it will be sort of a theoretical thing. But no, I feel that the measure we have taken in this particular situation is the right one to create resilience, or hopefully create more resilience, which is what we're aiming for. So is it going to work? I hope so.
And you've chosen more or less the LTI to reduce the flow there. Yeah.
Well, I will be perhaps more comfortable with the instruments which I have some idea of how to calibrate. I don't have any good ideas of how to calibrate LTVs, apart from using international experience, and I think this is the way it is being done, which is comforting, but not necessarily to the extent I would like it to be. So with debt service to income and debt to income, the framework that I have just sketched can be used, and I would then have some more comfort that decision is taken. It's a more informed decision. In terms of whether debt service to income or debt to income, debt service to income is not immune to low interest rate environment, and debt to income has an added advantage that it puts a threshold above on the likely increase in debt service to income. So the two together can be an option, but whether to introduce them or not, I think you should have cost-benefit analysis.
I agree on that. And I think in the end what some people do with debt service to income to escape the low interest rate environment is to put, for example, a 5% interest rate in, but then you could as well do the debt to income, because then it collapses to the same.
It's the same
measure. Yeah. So I think then at least the conclusion from this side is that the jury between the loan to income or debt to income and LTV is still open, and we saw the extensive experience in Ireland where they use both. So let's open the floor for questions. One in the front. Is there a microphone? Okay, and then you get the phone. Okay.
Hi, my name is Önundur. I'm from the Central Bank of Iceland. And my question is for Benjamin. As I understood your speech, what you're doing in Germany is kind of increasing the legitimacy of your toolbox by involving the legislature, but at the same time perhaps limiting your toolbox in that process. Is that a good way to go? Do you recommend it?
And I think we are here on Chatham House rules, so.
Thank you. So,
please. Yeah.
So, two related questions for Benjamin also. So, I understood all the political tension and the tense political debate that you had in Germany, but I was still wondering why there was a limitation about the availability of a toolbox. I can understand why there could be pressure against activating tools, but it's a little bit more difficult to understand how not even allowing macroprudential authorities to have something at their disposal. So it was a little bit surprising. And the second related question is, do you know why they chosen to reject DTI, LTI? So it's more or less related to your question. So apparently politicians in Germany do have a preference about LTV over DTI, DSI, but I'm not sure it's about effectiveness. It has anything to do about effectiveness. Thank you.
Okay. Maybe the last question, answering the last question first. One reason was data availability. So the industry was very reluctant to have higher data requirements in the future, and they said they lack the data themselves. That it's not easy to collect the data on income. Of course, you have the issue of defining what is the real income measure to use, and all this discussion led the politicians to decide not to include these instruments in the bill. And the other question, whether it's a good idea to have the legislator in the process, is something I cannot question, because the Parliament finally decides, and when the Parliament says we want to have a saying in what's going on there, or at least be part of the process. There will be a hearing with industry and also with the financial committee of the Parliament once you want to activate these instruments. Then, of course, if the Parliament or the members of Parliament want that, they get that because it's the legislator. And as we say in Germany, but probably you also say this in your countries, every bill enters the Parliament and it will not look the same when it comes out of the Parliament. So they always change something which they consider politically important or worthwhile doing.
But then we are still left with the long literature on timing consistency with monetary policy, which you, of course, have also in Macroprudential, and of course you discussed that in Parliament, but they are the boss.
But it's they have no veto power. Of course, they can abolish the bill later on if they think activation is not the right thing to do. They can, of course, abolish the bill later on. But that's, let's say, the nuclear option of not having these instruments being activated. But they have no veto power in the process. It's just to inform the parliament and also to have all the stakeholders on the table and to inform the public how we come to our assessment and how these instruments will be calibrated. And I think this is something, macroprudential policy has distributional consequences that are much more widespread than monetary policy in normal times. So I can, to some extent, understand that politicians are reluctant to give away these instruments, which are very powerful instruments. I mean, preventing young households, because they don't have enough equity now, from buying a house is a tough decision. And the question is, how can we make it or ensure accountability of those authorities who take this decision? And I think it's important to have this transparency and also these hearings. I mean, it's important for the legitimacy of our doing.
Can I ask the two other panelists to share a little bit their experience on, for example, in Denmark, the ministry decides, and also in your case in Poland, whether you are allowed to do it on your own, and to share your experiences with the political process?
In Poland, that depends on the measure that we would consider. So in terms of borrower-based measures, this is a micro-supervisor who would decide. The Financial Stability Committee can issue a recommendation, and this is how the macroprudential policy works. So it issues recommendations that are then on comply or explain basis are implemented by either Financial Supervisory Authority or Ministry of Finance, depends on the type of instruments. So in borrower case measures, this is Financial Supervisory Authority, and then they issue recommendations towards supervised entities. These are not necessary, from legal perspective, these are not binding. However, they are in practice very much observed because of the power supervisor has on on-site inspection, Pillar 2 instruments. So these recommendations tend to be observed, and this is how they have been implemented in Poland, as I shown on the chart, and this is still how they would likely be implemented or altered in future.
Well, for us, this is really a first. The recommendation that's come out now, it's the first time that we're sort of at the starting block for to see how it works. So I will be much wiser in in a couple of months. That's really obviously with the construction where the minister is the competent authority. We will have to see how it plays out, but I'm hopeful that we'll agree.
Yeah. I think at least one lesson I learned from it, I think checking also the Irish experience, is that once you start doing it, that you should have a strong framework in place, and that, like with the allowances, that kind of things, and that's exactly what you do in Denmark, then tinkering around with that is easier than each time for each change in the percentage you need a long lead time, because then the cyclical part can sometimes work the wrong way around. Any other questions? Two at the front and one in the middle.
Thank you. I have a question about Denmark, about location-based requirements. It was interesting how in practice this requirement applies. So is it based on the postal code, zip code? And when you were discussing that measure, what were the arguments in favor and against, sort of pros and cons? Could you a bit elaborate internal thinking behind that?
I have a question for Germany. So as a political process was so intense, but you have election in autumn, and your recommendation was not fulfilled. Do you have some plans to issue another recommendation, in a year or so?
And then we go to the Bundesverfassungs to decide. There's one question. Yeah.
Thank you very much. I have a question on the issue of FX loans. You have rightly pointed out that consumer protection plays a role in this respect, but my question is in the direction of financial literacy. Especially with these FX loans, we have made the experience that very often the people taking these kinds of loans have no idea about the functioning of an exchange rate. It's quite a complicated thing, so even in economics it's not so easy. And therefore I think there is a fourth column missing, which is financial literacy. In addition, I wanted to raise the issue that, especially with these FX loans, recently there is somehow to say a new trend, which is a conversion of these credits with the original exchange rate, which helps out, which is also some kind of consumer protection, because it helps out the private households who would make in some cases a big loss, but puts all the burden on the banks. So when we reflect on that, what does this mean in general on macroprudential instruments? Is there also the possibility to say, well, it goes now into this and that direction, therefore let's go back 2-3 years and implement something and revise all these contracts, which brings in a big part of insecurity into contracting. Thank you.
Your question on the FX loans reminds me of the political economy at the European Systemic Risk Board, because I think one of the first warnings was on FX loans, because it was extremely obvious to make that warning, and also quite acceptable to do that. So sometimes the political economy moves in favor, and that was, of course, very wise. But let's start on Denmark, on the location question.
On the location question, yes. Unfortunately, I can't tell you how it's going to be implemented in practice. It has to do with, again, that the Risk Council gives a recommendation. The political system will either follow it or not, but in this case it's also up to the political system to decide exactly how it's going to be done. So I cannot give you an answer as to how we will go about it. Was there much debate? But yeah, that was one of the issues that was debated. I mean, on the one hand side, you can see from the chart that I showed you, it is a phenomenon in Copenhagen and Aarhus. So you could make the argument that why should the rest of the country, in some extent, suffer from something that's not really their problem? They haven't seen house prices go up. They don't have the same problem. On the other hand, you could say, how are you going to, obviously, you're quite right to ask the technical question, how are we going to go about this? Can we put up this sort of wall? Does it make sense? How are we going to do it? You could also argue that if you look at where the losses actually are, they're not in Copenhagen. So in terms of resilience and all that, the losses you find are in fact outside, where, on the other hand, prices haven't increased. So it has been debated. I think we have to be, again, going back to the car I showed you, we have to be really humble about this. This is going to be trial and error. We will try it. We'll see how it works. If it doesn't work, we'll have to change it. So we'll have to put it out there and monitor how it progresses. But I think the good thing about it is, one thing that really concerns me, it was one of my points, is the inaction bias in this. It has taken us really long to get there, and I still think it's the right time to do it, but the cycle could have turned. We could have been in a totally different situation from when we started thinking about it. So I at the top of my mind is how to get around inaction bias. And I'd rather make, if you're going back to your type 1 and 2 errors, you could sort of make the type 1 error saying, do nothing when you should have done something, and then you can do something when you should have done nothing. I would rather have the second type error.
Okay. Now to Germany. Dare you ask to more from the...
Probably not. There are no plans. I mean, it's the Financial Stability Committee has to take note of the bill that is now being active, probably from October on. We have, as a Bundesbank, we have to evaluate the bill that was drafted compared to the recommendation, and we'll have to come up with some recommendation whether it's partially compliant or not. Of course, having no data probably makes it not fully compliant. But we'll have to see, and we have to see what we can do with the toolbox we will have in the future. Maybe another thing, and also regarding regional application of these instruments, we had during the discussions politicians or member of parliaments as well as the industry were asking for regional application. But at the same time, the industry was claiming that they have big issues delivering all the data we need for at the aggregate level already. So we said, okay, if we want to do it at the local level, then we need local data. So which means you need a local credit register in each and every bank, so that we can easily have this information also from a supervisory perspective, because you have to see whether banks comply with the regional LTV or not. So there was a bit of tension between what the industry on the one hand wanted and wanted on the other hand. So low burden, but at the same time a regional application of these instruments. And we also argued that if all these instruments are based on ratios, so usually they should start biting where the heat is on, and not in those regions where no huge price increases occur. And you, of course, you have the question of what is the optimal level of granularity? Where do you stop? Do you stop at the municipality border, or do you stop? Is it the zip code or whatever? What is the optimal level of granularity? And so we think that the most efficient way is to have it at the macro level and calibrate things in a way that makes sure that those regions who are where the heat is really on are affected, while the others are not.
And then a final question on FX loans and financial literacy.
Let me just start and explain the approach with type 1 and type 2 errors, because we do it with different preferences and ways for a countercyclical capital buffer. So then not doing something is type 2 error is more costly then, because the cost of the cost of introducing a countercyclical capital buffer in the upturn is found to be relatively small, and the impact on banks is not necessarily negative. So we provide resilience with relatively little cost. So then type 1 and type 2 errors have different weight relative to debt service to income, where we eliminate someone from the market. So this is so it's situation specific. On FX loans, we indeed the baseline draft regulation that is now being going through the parliament does not assumes just giving back the spread on FX lending between bid and ask spread that have been perceived as being unwarrantedly wide because they were at bank's discretion. And therefore, the impact on the banking industry is relatively limited, according to our estimates. And you have rightly pointed out that there was this tension between consumer protection and financial stability issues, particularly given that one of the presidential promises during the election time was that he will solve the FX problem. So it shows how loaded with political aspects the issue is. And indeed, while sometimes consumer protection at the beginning of at the initial phase of the boom can act together, when you mop up, there may be a conflicted interest, whether there will be huge losses in the financial sector that would affect stability and consumer protection. And then I think it's in the end up to the legal system which has an upper hand, regardless of economic reasoning.
To add to that, I think that's one strong reason why, if you separate in a Twin Peaks model consumer protection and prudential, then the two supervisors can really argue and battle a little bit about it rather than internally resolving it. Because with mis-selling, like also now in Italy with the bail-in bonds, they have been sold to retail. And if the prudential supervisor has been selling, is also responsible for conduct, then he has two tasks where he has to make a decision. And when you have two separate supervisors, then you can at least have at society level a good argument, and the two supervisors pursuing the different objectives. And indeed, finally, then the court will make a decision. But it's a strong argument for splitting consumer protection and prudential objectives, because sometimes they can be opposite. There was one question, and also one from you or not? Yeah, two questions, and that's the last round.
Thank you. I mean, a fascinating discussion about type 1, type 2 errors, and it reminds me of a conversation I had over lunch, which was, we're having a discussion here about marginal changes in policy in response to risks in housing, but it feels like we're having that discussion holding the level of capital in the system fixed, the level of liquidity buffers, the structure of the system, the efficacy of bail-in. We hold all that constant and say, are we going to jump in here? Are we going to make an intervention here? Yes or no? We may cause problems if we block people from access to credit. And I wonder, at least within this room, is that the right way to think about the problem? Should we also say, imagine for the sake of argument, capital levels were twice where they currently are. Then what would we do? And I think that's where John Danielson started as well. Should we lift that constraint once in a while when we think about these problems?
And a question at the front.
Thank you. A question on the fixed loans, but Piotr again. I don't know what are the current rules regarding the fixed loans currently, but I've read somewhere that actually it's very strict now. Our intention is to have it very strict by when using mortgage credit directive transposition. Maybe it's transposed already. And I've read that it's now very strict that loans can be issued only in Polish zloty. And if it is the case, I was wondering what's going to happen, because I think in Poland you also have an issue of immigration, and there's huge sort of community in other countries, for example, in Norway, in Ireland, and they receive income in foreign currency, but they would like to get a loan, and sort of I think there is a requirement that would be currency of a loan, and the income would be matched, and that might have an impact on your sort of credit growth, because if these people, immigrants, would not be allowed to have would no longer have access, would not be able to borrow in Poland, that could have implications for credit growth. And I wonder, maybe you have data as well, how large is this borrowing actually compared to the total stock of the loan portfolio, if you have any sort of information about that? Thank you.
Let me start with the second, and I will leave the floor to the first.
Thank you.
So, indeed, the law has been signed, so the directive has been implemented and signed by the president, so there is no FX lending without a natural hedge, so you would have to have income in this particular currency. We do not see people from abroad, so Polish migrants asking for loans in Poland. I think it would be more straightforward for them to apply for a loan in UK, for example, because then the lender would know better the probability of losing a job. So we do not, basically they have stopped. But there is potential for, if you have income in foreign currency, you can do it. But we do not see it yet.
normally in academia we would now say ora est, and then we would have the tea, but maybe the two panelists want to answer the question. Okay, then I just ask for final remarks, if there are any final remarks from the panel.
No, maybe a comment. Maybe I'll try to see if I grasped it right. So I think you were saying that should we remove some of the other restrictions that appear to be on this increased capital levels, for example. Well, sort of one political practical answer is it's outside the realm of the Systemic Risk Council. So we, in this context, would be somebody else than we here, in a sense. And then the other part of the answer is, to some extent, the Systemic Risk Council can, by the buffers, increase capital levels or resilience that way. But it doesn't really answer your question.
But would you like to see capital levels go down? So coming back to the, you want them to be up? Okay. So that we. Nothing to add.
I can add on it. There is a strong academic consensus that higher leverage ratios would solve a lot, and we need a lot less other rules. But
there is a question to what extent supervisors can do it on their own, and to some extent, I believe they can. The issue is competitive pressure. From abroad. So this is the single challenge. Because in many cases I see capital ratios in countries being much higher than what is the Basel and CRR minimum and CRD minimum. And you can use add-ons for Pillar 2 which are truly Pillar 2 or macro in disguise, and this is being done. But there is a question to what extent there is international competition that is preventing it from doing, and you need to really have to have a coordinated effort to do it. And without it, it is unlikely.
I agree, and including like in Europe with the SSM, that you get a strong similar requirement rather than that countries are topping up. On that note, I would like to invite everybody for tea or coffee, and after thanking the panel.
Thank you.